Research at Citi, Markets Edition.
Welcome to Research at Citi, Markets Edition, where we break down global macro in 10 minutes or less. I'm your host, Dirk Willer, Citi's Global Head of Macro, and with me today is Adam Pickett, our London Macro Head. Welcome to the show, Adam.
Pleasure to be here as always, Dirk.
We are recording this podcast at 9 a.m. on Monday, December 8th, 2025. 2025 was an eventful macro year, but what assets will work in 2026? Let me start laying the scene a little bit. Our economists are calling for Goldilocks for 2026, which means growth that is more or less in line with this year, so relatively strong, and where inflation is maybe slightly elevated on the services side, but broadly in line with where it should be. This means that central banks will probably cut less than they did this year, so the breadth of the cutting will narrow, but we don't expect a lot of central banks hiking. So monetary stimulus will still improve from here. And this environment is, of course, a good one for risky assets. And as a result, we are still overweight equities. Of course, as you know, we are believing that valuation is this fly in the ointment for risky assets, and we do believe that the US equity market is in a bubble. We also have seen cracks in the AI story a little bit, especially surrounding OpenAI, where worries have increased both around the intense competition in the field and the huge funding needs that have to be met somehow. But we don't believe that the bubble has peaked yet. And that's for two reasons. One is we haven't seen this optimism and very heavy positioning that you typically see when the bubble peaks, and that we certainly saw in 2000. And second, liquidity is also not tightening. And bubbles need liquidity. And the reason, I think, why 2000 peaked when it did was partially because the Fed had increased liquidity tremendously going into Y2K because of the Y2K bug, and then removed that liquidity again early in 2000. And that was very important for the timing of the end of the bubble. And this time around, of course, we see liquidity fairly benign, both because the Fed is cutting, which is actually very rare in a bubble period, and secondly, also because liquidity in terms of the Fed balance sheet is likely to be benign and possibly improve going forward. One issue for next year is, of course, that it's midterm election year, which is a period where typically the S&P does not do all that well. Though we would say the really risk around the midterms is typically more a Q3 type of event rather than a Q1 or Q2 type of event. So we stay quite positive here into next year.
Dirk, overweight the US, I'm sure is reasonably consensus. Do we have any diversifiers?
Good question. I mean, I think so. Diversifying should happen both across countries and across sectors potentially. So on the country side, we think China offers a good way to diversify, which is not that obvious because it's, of course, also partially an AI story. However, it is the index, the global market that's least correlated with the US. And also the AI story is least correlated with the US AI value chain, because if you buy Korea or if you buy Japan or if you buy Taiwan, you're essentially still on the US AI value chain, while if you buy China, it's a completely separate AI value chain and a very high quality one. It also has, of course, cheaper AI assets. The cheap power is a big advantage for China as well. And then the liquidity situation is still quite good because deposits are still flowing into the brokerage sector. So we quite like that as a diversifier. On the sector level, it's also an interesting question. What is important to realize is that in past bubbles that were tech-driven, the tech sector peaked on the day when the bubble peaked. So if you don't think the bubble has peaked, you should still keep tech. And that's important. The big sector rotation happens after the bubble, or is coincident with the bubble peaking, not before. Now, one thing that we do see is that cyclicals over defensives do also quite well during the bubble, but that peaks 1 month before. So that would actually be a warning sign to look out for, but also it means that right now we should still be positive on cyclicals, where we have picked financials, and we recently also upgraded healthcare, which is relatively cheap. Regulatory risk has been priced, and which could be a beneficiary from the AI story. But Adam, bubbles don't just need diversification; they also need hedges. What do you think are interesting hedges?
It's a great question, Dirk, and I think you've already laid out why in equity land hedges are difficult, because in a slightly broader world, one is just that other sectors don't do poorly, but also in a bubble, your leadership rarely rotates, and so you don't get much opportunity for big sectors to help you out. We still like credit. When we've looked at IG credit underweights, both in Europe and the US, in risk scenarios, so big sort of market shocks, on a risk-adjusted basis, in spread terms, credit shorts or underweights outperform long JGBs unhedged, long gold, or short the S&P 500. So from that perspective, we think they are favorable. but also from a hedging perspective, you tend to pay away performance. You tend to get, strike drift with hedges, but credit has been materially underperforming equities on a risk adjusted or beta basis in the US all year. And that comes by construction. There's still not that much AI or less AI in credit indices than equity indices. And the only way that really changes is if the AI names do an enormous amount of issuance, which we wouldn't see as too credit positive anyway. And so net, we like credit underweights as a way to ballast our equity overweights in the portfolio.
Right, Adam. What about fixed income? I mean, that's a normal hedge for equity downside is treasuries, right? So what are your thoughts there?
Yeah, it's a tricky one outright for treasuries. We still have a relatively reflationary backdrop for next year. Economic surprises globally posted their third longest consecutive streak of positive surprises on record for the index. The asset risk looks for a full 26 basis reasonably well priced. Citi has two cuts for next year, but mostly centered at the beginning of the year. And we think there's a risk of a rebound in the US economy in the middle of the year. We'd have a steepening bias. And so for those that can do it, steepeners probably represent a decent macro hedge. But outright on treasuries, we're neutral. We're overweight gilts. We think that the BOEs still look underpriced. The issuance profile coming out of the budget, skewing heavily towards shorts versus history means that issuance profile is particularly healthy for gilts with the lowest DV01 issuance profile potentially in 5 years. And while there is some risk around the May local elections, we think it can still have a very good start to the year. France, we're underweight, not enough political risk premia. Nearly 50% of the net cash requirement is coming in the first quarter of next year. Plus, you still have some lingering upside risk to yields in Europe coming from an ECB being done, coming from pension fund reform in Holland, as well as potential defense spending risks longer term. And lastly, on Japan, we stay underweight. It's been one that we've had for a while. We may be close to the back end of that trade rather than early in the trade, but certainly the structural story in the Japanese labor market still mean that the BOJ probably stay the course and can hike a bit quicker than is expected from here, or at least the market can chase that theme. If they don't, it's probably because you've had political pressure and more fiscal, in which case, again, we think that the back end probably still stays under pressure. So neutral overall in fixed income, but still we think plenty of long short opportunities. Dirk, one of the other places we're still overweight is EM sovereign. Amazing year for EM last year. Do you think the party's still going to continue?
Yeah, EM local, not necessarily EM credit, right? But yes, it was a great year, benefited both from aggressive easing cycles and from strong currencies. And of course, next year will not be quite the same. Some central banks have reached where neutral rates are roughly and are therefore pausing because growth is not falling off a cliff in most places. So you will not get the same tailwind from the local central banks. However, we also don't think you will see hikes. I mean, growth is broadly speaking still below potential, and we never really overcut anywhere. So the rates part will be more neutral, but the EMFX part will do more of the heavy lifting. And that is because I think for EM local FX unhedged, you really just need relatively stable US rates and a stable big dollar. And that's good enough for carry to perform, especially if volatility remains low. Now on volatility, very, very hard to forecast, but our best indicator is actually to just look at the implied volatilities of the various cross macro assets. And our indicator is telling us that we still stay in a fairly benign environment for EM carry. So we stay overweight EM local, and we do think EMFX will have to do more of the heavy lifting, but it still seems an attractive position in relative terms. Okay, so we still like high yielding EMFX, but what about GTNFX, Adam? And then what about commodities?
Thanks, Dirk. It's always tempting to say next year is going to be a year of two halves, especially for the dollar. I'm going to go one further and say maybe it's going to be a year of 3/3. At the beginning of the year, Citi still have the Powell Fed as being slightly more dovish than what is priced. So we still have December, January, and March penciled in for cuts, which I think could probably still see some dollar downside as we start the year, potentially trending back towards the recent lows. Into the middle of the year, once we're past peak US cyclical weakness, peak local Fed dovishness, the dollar can probably rebound as we see the economy rebound, as well as the AI bubble still attracting capital inflows. And I think there's a risk at the end of the year, either from coupon issuance. Our rate strategists think that issuance is going to skew longer dated towards the end of the year. We could see some term premium issues towards the back end of the year, which from our work has typically been dollar negative. On commodities, we are slightly out of consensus neutral on gold rather than overweight. In global cyclical recoveries, we find that gold tends to do less well, and we're not big buyers of the structural debasement, Fed independence risks, slightly dovish risks, but not debasement risks, which have been supportive for gold. So we think that that debasement risk is fading into next year. Rather, we are quite positive on base metals. Both copper and aluminium, big parts of the index, have strong cyclical upside in cyclical recoveries for the world. Copper has supply risks from mining dynamics. It has positive demand risks from the energy transition and EVs. Aluminium is very energy intensive and effectively competes with data centers on the supply side now, and that features heavily in some of the weaker supply backdrop for Ali from our commod strats next year. So both of those perspectives were bullish. Oil still bearish. Mostly see that the supply picture is quite robust next year, and structurally the world has become less and less oil intensive per unit of growth.
Great. Thank you, Adam. So in summary, our economics team believes in Goldilocks for next year, which is generally risk-friendly. We overweight equities, but given that we do think we're in a bubble in the US, hedges are needed, so we are negative on credit. Neutral fixed income, long EM and gilts, but on the negative side, it's France and Japan, and we're long commodities, but we prefer base metals over precious. Thank you for joining us today. This episode was recorded on December 8th, 2025, and I'm your host, Dirk Willer. For more details, Citi clients can check out our report on Citi Velocity. Next week, we will have Beata Manthe, our head of European equity strategy. And be sure to watch our Research at Citi podcasts, which you can find on the same channels. The macro strategy team will be back in the new year, and we wish our listeners a happy holiday season and a great start to 2026. Stay sharp.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyrights 2025 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Citi and Arc Design are trademarks and service marks of Citigroup Inc. or its affiliates and are used and registered throughout the world.